Most people lose money in the stock market, not because they're stupid, not because stocks are bad, but because they treat the market like a casino. They chase tips from social media. They panic when prices fall. They celebrate when prices rise, without ever asking the most important question: what business am I actually buying? See, here's the truth. 90% of retail investors don't do real research. They don't read balance sheets. They don't understand business models. They buy logos, not companies. And that's why the rich win, while the average investor bleeds. Because the rich don't play the stock market. They study businesses. They value them. They invest with conviction. This video is your gateway into equity research, not the boring academic kind, but the kind that lets you analyze any stock like a professional and build conviction when others are panicking. Let's begin. So what exactly is equity research? It's the process of studying a company, from its financials to its business model to its place in the industry, to answer one question: is this business worth investing in at this price? That's it. Simple, but not easy. Speculation versus research. Most people speculate. They buy because a friend recommended it. They saw it trending on Twitter. They read a bullish article. That's not research. That's gambling. Research means going deeper. How does this business actually make money? Can it keep growing? What risks could destroy it? Is the price fair or inflated by hype? Think business, not ticker. This is the first mental shift. A stock is not just a ticker symbol on your app. It's a piece of a real business. When you buy Apple stock, you're not buying 4 letters, AAPL. You're buying the iPhone ecosystem, Apple Music and services, their brand, their customers, their moat. When you buy Reliance stock, you're not buying a name. You're buying oil to chemicals, Geo Telecom, Reliance Retail, future expansions in green energy. Stocks equal sign businesses, and businesses equal sign stories written in numbers. Equity research isn't about predicting next week's stock price. It's about building conviction. Because when you know what you own, short-term volatility doesn't shake you. In Chapter 2, we'll dive into the heart of research, analyzing business fundamentals, revenues, profits, debt, management, and moats, the elements that separate fragile companies from wealth compounding machines. If equity research is about treating stocks as businesses, then fundamentals are where you begin. Fundamentals tell you whether a business is healthy, fragile, or hiding something. It's like running a medical checkup: blood pressure, heart rate, stress levels. Let's walk through the 5 key pillars of business fundamentals. 1. Revenue, the top line. Revenue is the money a company makes before expenses. But don't just look at the number. Look at the growth trend. Is revenue increasing year after year? Is growth consistent, or does it swing wildly? Where is growth coming from? One-time sales or recurring streams? Example, Apple. Its hardware sales matter, but the real growth engine today is services. App Store, iCloud, Apple Music. Recurring revenue equals stability. Rule: healthy businesses show consistent, repeatable revenue growth. 2. Profits and margins. The bottom line: revenue alone means nothing if costs eat it up. That's where net profit and margins come in. Gross margin: revenue minus cost of goods. High margins equals pricing power. Operating margin: how efficient the company is after expenses. Net profit margin: final earnings after taxes and interest. Compare margins over time. Stable or rising margins: strong management. Falling margins: red flag, competition, rising costs, weak moat. Example, Tesla's margins spiked during EV hype, but when competition increased and pricing wars began, margins fell sharply. Rule: profits should not only exist, they should scale as the company grows. 3. Debt and balance sheet. Strength debt is not always bad. Used wisely, it accelerates growth. Used poorly, it destroys. Check. Debt to equity ratio. How much leverage the company uses. Interest coverage ratio. Can profits comfortably pay interest? Free cash flow. Is cash flow positive or just accounting tricks? Example: airlines often carry massive debt. When COVID hit, they couldn't service it. Many went bankrupt. Meanwhile, companies with strong cash reserves, like Apple's $50B+ war chest, survived and thrived. Rule: strong balance sheets protect wealth in recessions. 4. Management and governance numbers tell you what happened. Management tells you what will happen. Ask: who is running the company? What's their track record? Do they own shares themselves? Skin in the game? Are they transparent in communication? Letters to shareholders? Calls? Any history of fraud, regulatory issues, or scandals? Example: Warren Buffett invests in people, not just businesses. He looks for trustworthy management with integrity and vision. Rule: bad management can kill even a great business. 5. The moat. Competitive advantage. A moat is what protects a business from competitors. Brand power. Coca-Cola. Network effects. Facebook, Uber. Cost advantages. Walmart. Patents and IP. Pfizer. Ask: can new competitors easily copy this model? Does the company dominate market share? Will it still matter 10 to 20 years from now? Example: Google's search engine has over 90% global market share. That's a moat. If a company passes these 5 tests, it's worth moving to the next step, because understanding the business is only half the job. The other half is figuring out if the price is fair. And that's what we'll cover in Chapter 3, Understanding Valuation. Why price and value are never the same. You can find a company with growing revenues, strong profits, and even a solid moat. But if you overpay, you still lose. That's why valuation matters, because the price you pay determines the return you earn. Remember Warren Buffett's golden rule: it's better to buy a wonderful company at a fair price than a fair company at a wonderful price. Price versus value. Price equals what the stock trades at today. Value equals what the business is actually worth. Your job in equity research is to bridge the gap. If value greater than price, opportunity. If price greater than value, danger. Key valuation tools: 1. Price to earnings, PE ratio. Compares stock price to earnings per share. Low PE may signal undervaluation. High PE may signal overvaluation or strong future growth. Example: tech stocks like Tesla or Amazon often have high PEs because investors bet on future expansion. 2. Price to book, PB ratio plus, compares market value to book value, assets, liabilities. Useful for asset-heavy industries, banks, real estate. Example: a PB below 1 could mean the stock is trading below the value of its assets. 3. Return on equity, ROE, and return on capital employed, ROIE, measures how efficiently a company uses shareholder money. High, consistent ROCE, signals strong profitability. 4. Dividend yield, shows how much a company pays shareholders relative to price. Not all companies pay dividends, but stable yields can indicate maturity and stability. The trap of ratios don't tell the whole story. A low PE stock may be cheap for a reason: declining business, poor management. A high PE stock may look expensive, but actually reflect strong growth potential. Valuation is not about one number, it's about context, margin of safety. This is the ultimate principle. Never buy at perfection, always leave a cushion. If you think a company is worth $100 per share, don't buy at $99. Buy at $70, $80. That safety margin protects you from errors in judgment or market downturns. In Chapter 4, we'll expand the lens, not just the company, but its industry and macro environment. Because no business exists in isolation, it competes in a battlefield shaped by cycles, rivals, and global forces. A company doesn't exist in a vacuum. It exists in an industry battlefield, fighting competitors, adapting to regulation, shaped by economic forces. And if you ignore that battlefield, even the best company on paper can collapse. 1. Industry positioning. Who's winning the war? Ask, what's the company's market share? Is the industry growing or shrinking? Are competitors stronger, weaker, or catching up fast? Example: Nokia once dominated mobile phones, but the industry shifted to smartphones, and Apple plus Samsung overtook them. Blockbuster looked profitable until Netflix redefined the battlefield. Rule: a company is only as strong as its position in the industry war. 2. Growth drivers. Tailwinds or headwinds? Look at the forces shaping the industry. Technology shifts, AI, automation, EVs. Demographics, aging populations, Gen Z spending patterns. Regulation, taxes, bans, subsidies. Consumer trends, eco-friendly, digital-first, health-conscious. Example: renewable energy companies have massive tailwinds due to global climate policies. Cigarette companies face long-term headwinds from regulation and health awareness. Rule: pick businesses riding tailwinds, not fighting headwinds. 3. Macro factors. The economic climate. Every industry breathes in the global economy. Interest rates. Rising rates hurt real estate, boost banks. Inflation lifts commodity prices, squeezes consumer goods. Currency moves. Strong USD hurts exporters, helps importers. Global trade, supply chain disruptions, tariffs, wars, all can crush margins. Example: airlines were crippled during COVID, not because they were bad businesses, but because macro conditions shut down travel. Rule: even great companies suffer when the macro tide turns against them. The wealthy know this. That's why they don't just ask, is this company strong? They ask, is this company strong in the right industry at the right time? In Chapter 5, we'll put everything together with a real case study, breaking down a company step by step, using fundamentals, valuation, and industry analysis. So far, we've studied the frameworks. Now let's put them into action with a case study. Let's analyze Apple Inc., one of the world's most valuable companies. Step 1. Fundamentals: revenue growth. Apple generates over $380 billion annually. Services: App Store, iCloud, Apple Music now contribute 20% plus, making revenue more recurring and less dependent on iPhone cycles. Profits and margins. Apple has industry-leading gross margins, 43%. Net profit margin, 25%. That means 25 cents profit for every $1 earned. Exceptional efficiency. Balance sheet: $60 billion plus in cash reserves. Manageable debt, easily covered by free cash flow. Strongest balance sheet among global tech giants. Management. Tim Cook is not Steve Jobs, but he turned Apple into a supply chain and operational machine. Consistent innovation in services and wearables, moat ecosystem lock-in, iPhone plus Mac plus Apple Watch plus iCloud. Switching costs are high. Once you're in, you rarely leave. Fundamentals: strong, consistent, resilient. Step 2. Valuation. Apple's current PE ratio, approximately 28, as of 2025. Higher than historical averages for mature companies. Reflects investor belief in continued growth, especially from services and AI integration. DCF models often price Apple at or slightly below market, meaning it's not a bargain, but a stable compounder. Conclusion: Apple is rarely undervalued, but it consistently compounds wealth. Step 3. Industry and macro industry. Smartphones, saturated but sticky. Services, growing strongly. Wearables and health tech, expanding. Macro powers. Inflation and supply chain issues affect production costs. AI and AR, Apple Vision Pro, could create new growth engines. Global diversification protects against regional shocks. Step 4. The researcher's lens. So, is Apple a good investment? Strengths: moat, balance sheet, recurring revenue, brand power. Risks: dependence on iPhone cycles, regulatory pressures, antitrust in App Store, slowing hardware growth. Valuation: not cheap, but fair for a fortress business. Quiet investors don't chase Apple expecting it to double overnight. They hold it because it's a stable compounding machine, a wealth anchor in their portfolio. In Chapter 6, the final chapter, we'll tie everything together, giving you a step-by-step stock research framework you can apply for life. We've covered a lot. Fundamentals, valuation, industry analysis, a real case study. Now let's simplify everything into a step-by-step framework you can use to research any stock in the world. Think of this as your research checklist. Step 1. Understand the business. How does it make money? Who are its customers? What problem does it solve? If you can't explain the business in one sentence, don't invest. Step 2. Study the fundamentals. Revenue growth, consistent, not erratic. Profits and margins, improving, not shrinking. Debt levels, manageable, not suffocating. Cash flow, positive, not accounting tricks. Management, trustworthy, with skin in the game. Moat, brand, cost, network, or patents. Step 3. Check the valuation. PE, PB, ROE, ROCE. Compare with industry peers. DCF if possible. Estimate intrinsic value. Always apply a margin of safety. Step 4. Analyze industry and macro. Is the industry growing or dying? Who are the competitors? What macro forces, rates, inflation, regulation, affect it? Step 5. Write the story. Put it all together. This company is strong because... Identify risks clearly. It could fail if... Make sure the narrative makes sense. Step 6. Decide with conviction. If value greater than price, and you trust the business, buy. If price greater than value or fundamentals are weak, wait or walk away. Revisit the company every 6 and 12 months to update your thesis. This was your Equity Research Masterclass. If you learned something, don't let it stop here. Subscribe. I'm building an entire equity and stock market research lab playlist. Comment. Which company or sector do you want me to research next? I'll build future videos around your requests. Share. Send this to a friend who gambles in the stock market and show them how real research looks. Because in the end, stocks aren't lottery tickets, they're businesses. And once you learn to research them, you stop being a gambler and start being an investor.